Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. Kind of a quick perspective and overview of the business if you guys have not participated or listened to any of our webinars in the past. TaxConnex is a sales tax specific company, and I really think about what we do in three primary categories. One, I would consider a consulting advisory type of service. So a lot of times businesses come to us and they just have questions about, do I have Nexus and do I have sales tax exposure, and is there any opportunity to, remediate some of those sins of the past, so to speak. So we help companies address those types of issues. We also have a software that plugs in and integrates to the shopping cart or to the billing system to automate the calculation of the sales tax and getting that applied to the invoice or within the shopping cart. And then the third category of service that we provide is the compliance outsourcing service, where we essentially become an outsourced sales tax department for businesses and manage their sales tax registrations, their returns, even their exemption certificates. So that's kind of a quick overview of our business. Personally, Jeff and I have been doing this way too long, about 25, 26 years on my side and 30 plus from Jeff's side. So I'm going to rely heavily on Jeff during this presentation, but he's got a good knowledge base to share with us. Just from an overall agenda perspective, we always start, and I say always, most of the time, I think we start with some type of Nexus discussion. It is the foundation for all things sales tax related, so it's always good to have that initial kind of overview from a Nexus perspective, as well as a taxability discussion. But then we'll really get into kind of the core of the presentation, more specifics around sales tax and some of the struggles from an e-commerce and retail perspective, specifically with drop shipment scenarios, which are very common in this industry and have become more and more of an issue over the last several years. We'll also talk about how marketplace facilitators fit into this whole puzzle and how it can be a good thing to work with a marketplace facilitator, but there are also some things that you need to be aware of. And then we'll kind of wrap up with a quick discussion, just what are some ideas and steps for managing the process in terms of the registrations, calculations, and filing of those sales tax returns. So Jeff, I'll let you start with the Nexus piece here.
All right, thanks, Brian. Yeah, it is this particular topic, e-commerce, is really relevant because, so let's talk about Nexus. Nexus is really a term used to define whether or not you have ample activities within a jurisdiction that will allow that jurisdiction to impose its taxing authority on you. So when we're talking today, it's purely about sales tax nexus. And another way of saying it is, what's your sales tax connection to any given state? And historically, that was a physical presence test, meaning you had to have some degree of physical presence in the way of inventory, an office, employees. And that physical presence could be permanent or temporary. There were scenarios where sales reps could enter a state for periods of time, and that activity in and of itself, the mere activity of solicitation, could trigger a nexus for sales and use tax purposes. So over the course of about 50 years, because really in terms of the definition of physical presence, we can go all the way back to the 1967 court case with National Bellis Hess versus Illinois, where the state of Illinois essentially asserted that a catalog clothing type store had established nexus by sending their catalogs into the state. And it was during that case, or near the end of that case, where the courts defined examples of what physical presence was defined as or represented for sales and use tax purposes. Fast forward, we get into the Amazon era, and there were some challenges along the way. There was the Quill decision in 1991, where the state of North Dakota had actually challenged Quill, who was making phone calls of soliciting business within their state, and they tried to assert nexus on that level. But what really started to make people nervous was around that era when e-commerce really started blossoming. And as we got out of the 2000s, in the late 2000s, early 2010s, we started seeing states trying to get more and more creative. They wanted to make sure that the tax base wasn't eroding due to the fact that e-commerce vendors could essentially do business in the state through the websites and ship product into the state without having to charge tax. And the states recognized that there was no way feasible for them to recover that tax as a consumer's use tax against individual consumers across the state. So there was also the fact that in-state retailers, brick-and-mortar retailers, certainly felt disenfranchised. They felt like they had an obligation to charge tax on their products while another vendor in the same maybe product category didn't have to charge tax. We saw things like there was a click-through nexus determination, or the Amazon law that happened out of the state of New York, where New York said, look, if you're going to host a website where you have the ability, or a customer has an ability to click through your website and gain access to another external website, that will give that external website nexus, the mere presence of that website within the state through which you might have clicked. We saw some other states get a little bit more aggressive. Colorado came out and said, we want you on an annual basis, if you're going to act in a remote seller capacity, meaning you're not going to have nexus here physically, you're going to sell product through the internet. If you sell more than $10,000 of product into our state each year, we're going to expect you to submit a list of all of your customers. And we're also going to expect you to put on all of your invoicing a statement that says the customer is responsible for accruing and remitting use tax. And if you did not want to comply with that rule in Colorado, you had the alternative, which was to register and comply. So it was really an arm-bending tactic on the state's part. There was about 13 or so states that kind of enacted similar types of administrative policies, if not legislation, around a combination of click-through nexus and some of these reporting requirements. Around 2016, we saw South Dakota formally introduce legislation and pass legislation that was considered the first real sort of stab at an economic nexus standard. And in that legislation, the state determined that any vendor selling $100,000 worth of product into the state during a 12-month period or calendar year would have established nexus essentially for sales and use tax purposes, and would thereby be responsible for registering and charging tax on all their transactions. Interestingly, they kind of built into that legislation an expedited legal process, because this was, again, an evolving area across the country. Everybody was a little bit anxious about it, nervous about it, angry about it. There was federal legislation being considered in this regard. So what South Dakota said was, look, when this is challenged, we want an expedient way for this to flow through the courts so that a ruling can be made as to whether it's constitutional. Lo and behold, we end up with Wayfair being assessed by the state of South Dakota when they asserted nexus for this economic standard, and Wayfair decided to fight the case. This went up through the South Dakota Supreme Court, and interestingly, the South Dakota Supreme Court ruled in favor of Wayfair. So they ruled it was an unconstitutional legislation. the state of South Dakota asked the U.S. Supreme Court to hear the case, and in April of 2018, that's what happened. The U.S. Supreme Court did hear oral arguments from the state and from Wayfair, and as you might imagine, there were a number of states that lined up behind South Dakota. There were a number of vendors that lined up behind the states, and there were vendors that lined up behind the states as well as behind Wayfair. So it was a really interesting crowd. Brian and I were talking with some of the larger retailers out there that everybody would know their name, and they had a vested interest in it, and they were kind of watching it. Everybody was hedging their bets. June 2018, U.S. Supreme Court releases their decision 5-4 in favor of the South Dakota legislation, therefore, and thereby deeming it constitutional. And as you might imagine, all the states were already in line and had already introduced legislation, or drafted, I should say, legislation along these same lines. And so today, what we really have is a mixed or a hybrid nexus policy, one that still resembles the old and trustworthy physical presence. That didn't go away as a result of economic standards. It still exists. And then the economic principle has been adopted throughout the country. There are certainly nuances or variables between one state and another as to how that's calculated. What we like to tell our clients or companies that we talk to is use that $100,000 rule. That's sort of the baseline. There are some states that have a higher threshold. There are also a number of states that have what we refer to as transactional thresholds. And in fact, South Dakota in their initial legislation had this same language. They had a 200 transaction threshold, and it was an either-or policy. You either could exceed the $100,000, or if you didn't exceed the $100,000, but you had more than 200 transactions in a 12-month period, that too gave you an economic nexus. So it's interesting that some other states followed course, and in some of those states, that $200 threshold has been repealed. And in fact, in South Dakota, that 200 threshold has since been repealed. But there are still some states out there that have it. The other thing that's a little interesting is that there are some states we'll talk about a little later in this discussion, Colorado, Alabama, and even Alaska. If you see on your screen, if you're watching this webinar on the screen, you see some grayed out states. Those are states that don't have a state sales tax. But you'll note that Alaska is kind of light blue. It's in between the dark blue and the gray. And that's because the cities in Alaska administer their own sales tax. Many of them do. Many of them have their own sales tax function and administration. They've kind of consolidated as an organization of small cities and said, if you reach a certain threshold of sales within the state of Alaska, you now have nexus with our city, and you have to start charging tax in our city. And they use that 100,000 threshold. So Colorado's cities did the same thing. They have what we call home rule jurisdictions that implemented a similar policy. Alabama similarly as well. So again, for e-commerce businesses, which were most, I think, impacted by this, it was e-commerce and technology businesses that were primarily targeted and impacted by this legislation. We still find today, Brian and I talk every day with somebody, maybe every week at least, with somebody who has found themselves unprepared and has not recognized their breadth or scope of their Nexus footprint, and they're operating in an e-commerce fashion.
Yeah, Jeff, let's just pause for a second and take one of the questions here. And I might address it for the audience, but how do you know if having a salesperson go into a state 2 to 3 times a year, how do you know whether that creates physical nexus or not? And the way we typically would reply to that is most of the states aren't going to have a specific notation in terms of X number of days. They use like the vague terminology of a substantial physical presence, and then you're kind of left up to interpretation as to what is substantial. There are some states that do have specific measures. Michigan is one that comes to mind that they reference a single day in a 12-month period of activity in their state is sufficient enough to create nexus. So we usually, quite frankly, we do use that kind of 2 to 3 days as our conservative position that would create nexus for sales tax purposes. But when you really start to look at it and you get inside it and you think, well, how would a state ever even know that I traveled into a state? They may not, but we just kind of look at it and say, if the state knew what we know, what would they do? So we tend to use 2 to 3 days in a particular state as having physical presence, other than a state like Michigan, which has that specific call out of a single day.
Thanks, Brian. Yeah, as we kind of migrate into the next category, which is taxability, the way we would like to talk about this is nexus is a distinct determination. It's a yes or no question. So it's why we start with this discussion. Do I have nexus? Yes or no? If the answer is no, we're not going to go further on any of these slides. There's no reason to talk about taxability. If the answer is yes, I have nexus, now there's an opportunity to ask the question, am I selling something that's subject to sales tax in that state? If the answer to that question is no, I don't make any taxable sales into the state, or my product or service is not subject to tax in that state, then you still don't have an obligation generally to comply for sales and use tax purposes. But the thing that makes sales tax so complicated is the variability across the states, the nuances that exist from state to state. There's a lot of similarity, a lot of overlap, but there's also a lot of distinct differences. And it's the fact that those distinct differences exist that creates a lot of risk and sometimes exposure for companies. So the baseline, when you think about taxability for sales tax purposes in all the states, is tangible personal property. The statutes typically will start out by saying something to the effect of the retail sale of tangible personal property is subject to sales tax. Tangible personal property is anything that can be perceived by the senses, essentially. Can be felt, measured, weighed, seen, all those kind of descriptors. Services, on the other hand, generally fall outside the scope of taxable transactions. But what you also see in that statement or that legislation is, in addition to tangible personal property, enumerated services are also taxable. And services is a broad category. And in a lot of conversations Brian and I have with companies, the term professional services comes up. So let me just kind of scale the services ladder here for just a brief moment. Telecommunications is a service. Lawn care is a service. The type of work we do is TaxConnex is a service. Depending on the state, some of those services could be taxable. And so it's important not to paint a broad stroke across all the states, even when you're talking about professional services. And when we use the term professional services, what we're referring to are 5 core services, that being medical, attorneys, legal, which is attorneys, CPAs, architects, and engineers. Those are what we would call the core professional services from a sales and use tax perspective. And what you'll find is that in 99% of the states, or maybe 96% of the states that have a sales tax, those core professional services are not subject to tax. The other thing that's challenging when you get into determining taxability is situs. Where is the transaction situs for sales and use tax purposes? If I'm selling widgets and I have them located in Oklahoma, and I have an online customer who orders widgets from me and has me ship them to Ohio, do I charge Oklahoma tax or do I charge Ohio tax on that transaction? So you go through the same exercise. Well, where do I have nexus first? Okay, I know where I have nexus. Now, are widgets taxable in Oklahoma? Are widgets taxable in Ohio? Yes, yes. Now, where is this transaction really situs for sales tax purposes? And the way to determine that is it's based on where title's deemed to have transferred. And in most e-commerce transactions, what we're dealing with is a FOB destination transaction, meaning you're generally going to find that products that are sold in mass quantities are going to be shipped via common carrier with an FOB destination designation. And what that tells us is that the vendor has responsibility or the risk of loss during transit such that it doesn't transfer to the purchaser until it reaches their doorstep or their loading dock. And so for that reason, the majority of times, at least in the volumes of sales that happen in e-commerce, they are typically cited for sales tax purposes where the product is received. Now, if you switch over back to services, that gets a little complicated because instead of being where the product is shipped or received, there is no product necessarily shipped or received. There is a perception of benefit. And so where benefit is received, generally speaking, is how we cite as service transactions. The other area that's very common for e-commerce activity, and this hits home again for the magnitude of businesses that have cropped up in the last 15 years, kind of the volume and the majority of them fit into one of these categories. But what we're now talking about is drop shipments. Drop shipments are sort of a matter of fact for a lot of transactions. A drop shipment typically involves three parties. We have a retailer, let's call that a website retailer that has opportunities to sell tangible personal product. Let's just use widgets again. And we have a customer in this particular example who's in Illinois who wants a widget. They go to the website, they order the widget, and this South Carolina retailer doesn't keep an inventory of widgets. They don't manufacture widgets, they just sell them. They are great at marketing, and that's about it. So what they do is they leverage a distributor. In this case, we're going to say the distributor's in Arkansas. As soon as that Illinois customer places the order, the South Carolina retailer is going to, in turn, place an order with the distributor in Arkansas and instruct that Arkansas distributor to ship that product to the address in Illinois. In this example, we're going to assume, and it is true because we say it is in this example, the Arkansas distributor has nexus in Illinois. And the Arkansas distributor knows that its product is taxable in Illinois. So it sets out to charge tax on that invoice. Despite the fact that it's selling to a South Carolina-based customer, it's that ship to address, as we just described. It's probably going to be an FOB destination shipment. And so title is deemed to have transferred in Illinois. And the Arkansas distributor feels obligated or is obligated at that point to charge tax. In this case, the South Carolina retailer has to provide some type of resale exemption certificate to the distributor. Otherwise, they're going to have to pay the tax. And if they're not registered in Illinois, which in this case they're not, South Carolina retailer is not registered for sales tax in Illinois, they're not charging that Illinois customer sales tax. So you run into this quagmire of, okay, now I got an Arkansas vendor charging me tax as the South Carolina retailer. I can't do anything with it. I can't get out of the tax because I don't have an Illinois sales tax resale number to give them. And I'm not registered in Illinois, so I can't pass it on to my customer. They get stuck. And it's a very common theme. It typically requires that South Carolina retailer has to make some business decisions, potentially needs to register in Illinois if it's going to do a magnitude of business in Illinois. And all of this, when you kind of peel this back and you start, the thing about sales tax is it's a constant 2 steps forward, 1 step back, 2 steps forward, 1 step back. We start going backwards and we say, well, wait a minute, eventually that South Carolina retailer is going to exceed that $100,000 threshold if it's a growing business. So eventually they're going to find themselves having to register in Illinois anyway. But in any case, this is a sort of tricky situation and it adds a little bit of complexity to doing business. Now we're going to take this to another level of complexity and use another example, a similar transaction type. We still have a drop shipment transaction, but in this case, it's an Utah customer that's making the purchase. And I'm not going to restate all the facts in this case, but it happens that Utah, and this is true in a number of states, by the way, happens that Utah will actually respect the retailer consumer transaction and allow that retailer, that South Carolina company, to issue an exemption certificate to the distributor, despite the fact that they're not registered for Utah sales tax purposes. What they'll allow them to do is use a South Carolina resale certificate or their South Carolina sales tax registration on a Utah resale certificate. And they'll be able to issue that to the Arkansas distributor, and the Arkansas distributor can accept it. All that sounds great, and this opportunity exists in a lot of states. However, in this sort of transaction, all parties have to be aware. And in a lot of cases, the distributors aren't necessarily fully aware of what options are available, and they've probably been burnt before by not having adequate certificates or valid certificates, and they have every right to decline the certificate or deny the certificate. So it is a tricky situation sometimes, trying to convince a distributor that it's okay to receive, accept, and treat that transaction as exempt for resale.
And Jeff, I got a couple of questions here related to this topic. And one of them, if you look at that distributor, and in both of our examples, the distributor had Nexus in Illinois and in Utah in those two examples. But if the distributor did not have Nexus in either of those states, they're not obligated to charge the sales tax, but that transaction does contribute to the economic nexus standard. That was the question. Does that drop shipment into that state contribute to the economic nexus standard in that state, which it does?
It does for both entities, both the retailer and the distributor.
In this next question, it's interesting. I don't know if we'll get the full answer here. But in this case, the retailer collects the sales tax from the Illinois customer, but they're saying that they did not have Nexus in Illinois and did not have the requirement to collect the sales tax. And can they now count that as income? My take on that, I'd be interested in your perspective, but once you collect the sales tax, it's got to be remitted to the state. So in that example, if you collect it from the state or from the customer and it's Illinois sales tax, you've now said and essentially forced your own hand to register and start reporting that sales tax to the state of Illinois. I don't see any scenario where you can consider that income. It's one of, if not the only cardinal sin from a sales tax perspective is collecting sales tax but not remitting it. Even in the rare scenario where we've seen companies on the invoice to the Illinois customer, they might state a reimbursement of sales tax paid to the vendor. That's not a great scenario either, and it's not a great methodology of compliance. But we've seen that on in scenarios where it might be a once-off transaction, that companies have kind of taken that position as well. Any other comments on that?
You said that very well. That's exactly right. We are not collecting tax and recording it as revenue at any point in time.
Yeah, even if the distributor charged it, we paid it, it's kind of a reimbursement, but it's not. Because I always think that a good way to look at this is that these are two separate transactions happening simultaneously. It's the sale between the retailer and the customer. That's one transaction, in the state's mind, completely unrelated to the transaction between the distributor and the retailer.
Exactly right. Yeah, you can't combine a flow-through transaction and treat it as one transaction and consider the fact that the state's been made whole, and I'm using my Nixon quotes when I say whole. The states don't view it that way.
All right, let's move on to the next.
Yeah, the next couple of slides here are really just talking about some of the complexities that again, I hinted at some of these already, but we'll just kind of talk through them. Some of the complexities that exist out there that you just might not be aware of. And that's primarily driven by home rule, what we call home rule jurisdictions. These are cities that have the authority to establish their own sales and use tax laws, and they typically will administer their own sales tax. Example, Colorado. Colorado has about 73 home rule cities. And essentially, if you're going to actively engage in business in Colorado as a remote seller, if you exceed that $100,000 threshold or that veil of $100,000 at the state level, you're actually creating nexus for yourself in all 73 of the cities. And I'm going to back up just a little bit on that statement because I don't believe all 73 cities have joined the program yet. I think there's about 5 or 6 that might not be there yet. But the vast majority of those cities are part of that program. So in essence, you have an obligation not only to comply at the state level, which has its own separate registration requirement and compliance requirement, but now you have a city compliance requirement. What that state did, or let me just say it attempted to do, was to create a mechanism whereby remote sellers could find it palatable to find themselves with Nexus and comply in a reasonable fashion without having to file 73 different returns every month. And so they created an online portal just for this purpose, for this consolidated sales and use tax reporting. It was a debacle, similar to a lot of the other things that we found Colorado has done relative to sales tax compliance. It didn't work. It was such a debacle that the state legislature had to get involved a couple of years ago and legislate and mandate and gave well, it's really a state-run program, but they gave the program heads an ultimatum: fix it by this date or else. And so it has been much improved. It's still not my favorite system. It's the SUTS system, as it's called, Sales and Use Tax System. But it has its benefits. I won't say it's the most efficient thing in the world. What I'm really wanting to illustrate here is that you may have obligations beyond just the state that you have to consider in terms of your compliance responsibility and where you might have to be registered. Alabama, very similar to Colorado in the home rule cities. Oh, and let me back up again. Colorado is unique in this regard. The cities, these home rule cities, actually the majority of them, almost all of them, find that downloaded software and software as a service is taxable, while the state of Colorado treats both of those as exempt from sales tax. So that is another degree of complexity that has to be taken into consideration. When we get into Alabama, it's a little more straightforward. The cities, for the most part, unless you get into lease taxes, for the most part, the city's administration and application of the laws and taxability are the same as the states. And Alabama has relatively single filing mechanism to help with the multiple jurisdictions. There's still registration requirements, though, at some of the home rule cities, like a Birmingham, Alabama. But you can still report it on a consolidated basis. Alabama's filing is a little bit complicated and challenging as well, not quite as bad as Colorado. We've already kind of talked about Alaska. There's a number of cities that have their own administration for sales tax purposes, and they are also working to have more of a centralized filing. Louisiana had not mentioned yet. The parishes are separate entities or administrative authorities in Louisiana. Most of the taxable transactions are treated the same at the state and parish level, and Louisiana also has a more consolidated filing mechanism, but there is some registration requirements there. And last, and I'd like to say least, Chicago. Chicago is the lone city in Illinois that we consider a home rule, and it's kind of weird because it's only home rule for taxes, like amusement fees, communications taxes. They have their own lease tax. So they're a little bit unique in that regard, that they have different tax treatment than the state for most of those items, and that they have some very specific forms and registration requirements at the city level that you have to adopt. Now, Chicago has its own city level threshold for Nexus of $100,000. So it's not that obviously, if you could meet the threshold at the state level, but if you don't meet it at the city level, you don't have to necessarily comply in the city of Chicago.
So Jeff, I'm going to go back in time here and go back to the drop shipment example here, because we got a question, and it's a real world situation where the distributor wants to charge sales tax, and the retailer says, "Hey, you know what? I got other options. I've got other distributors that I can buy the same item, and they're not going to charge me sales tax." What does the distributor do?
You know, it was a very common scenario as we were evolving in that e-commerce world, where local vendors were challenged by somebody walking in with a phone saying, "I can buy it online. I don't have to pay the tax." So you had brick-and-mortar companies adjusting their pricing to compete with that, to offset the tax impact. there are no choices. You have to decide what you're going to do in that scenario, and if you're not going to adjust your price to get yourself even with that other vendor, and more often than not, that other vendor's doing something wrong.
Right.
It's more common that they're not.
It's a matter of time before they either get caught or learn that they should be charging the sales tax as well. But
and we find this challenge across all kinds of transactions, but in this particular case, it's not a very uncommon scenario that we see this happen. We also see scenarios where one company interprets the statutes differently than another from just the pure taxability of a product. And somebody goes to buy and they go, well, this company says it's not taxable. Well, that doesn't mean they're right. And you're inheriting that tax liability if you buy from them and they don't charge you tax. Now you have a consumer's use tax liability. Obviously the states don't have the wherewithal and the resources to audit everybody. But if I were that distributor, I would make note of that. I would say, wow, that's interesting. Who is that vendor? I would love to explore working with that vendor, all the while thinking, I'm just going to call the state and tell them this vendor's not following the rules. Now, it could be that vendor is actually okay with doing that. They may not have nexus in that state, so they don't have an obligation to charge tax. So those can happen too.
Sure. Yeah, it's just not a good situation to.
Yeah,
there's no good answer. There's no right answer there.
It's really just another level of video that we're going to show you around the sort of economic nexus standards that were implemented. Once the states got their arms around remote sellers, individuals or companies that directly sold through their website in an e-commerce fashion across state lines, they then went to the other side of this equation that probably contributed mostly to this, the Amazons of the world. And they targeted them and established the term marketplace facilitator as a candidate for the same logic, in essence, forcing marketplace facilitators to become registered taxpayers and charge and collect tax on all their sales if they met that economic threshold in receipts from sales into that state. So today it's fairly common, and probably obviously everybody, that almost everything we buy on Amazon is going to have sales tax on it if it's taxable. So the facilitator, and by the way we think about this to define what a facilitator is that they make a platform available to third-party sellers who can present their products on that platform, and the platform itself facilitates the connection between the buyer and the seller. And the real important factor in all of that is that the platform accepts payment and processes payment for the product. So with those categories of attributes, those guys are going to be subject to these marketplace facilitator rules, which, and Brian said this, I think, in his agenda comment, there's some positives around that. Namely, if I sell all of my products, 100% of them through Amazon, I probably don't need to register anywhere. Now, I may have some other activities I need to worry about, like inventory purchases for resale, things like that. But you don't have the wide variety of state implications like you would otherwise with your own website. The other factor that Brian was alluding to or hinting at, I hope I'm not taking any thunder, but some states require you to use that gross revenue that's going through the Avalara system or the Amazon system and report that in part associated with your Nexus threshold. So if you have $9,000 in sales through your own website, but you have $99,000 in sales through Amazon, in some states you've exceeded that $100,000 threshold, and that makes your $9,000 in sales subject to tax as a result. So those are just some nuances that we wanted to kind of illustrate, point out, and share in terms of things you just want to be aware of. And I think at the end of this 1 hour or less that we're going to talk together, it's really just about awareness, giving you some pictures and hints at where you might want to just be aware if you're operating outside your state.
One of the things that is relatively new, a lot of people are utilizing Shopify, as their shopping cart, and it's a hugely widely popular platform. And historically, we would have always said Shopify is not a marketplace facilitator. It's a platform where you can develop your own website. There's plugins for the charging of the payment processing, but it's a separate platform. Now, recently, I think it was January of this year, sometime earlier this year, Shopify came out with a new platform that's called Shop. And if you're a Shopify merchant, so you're using the Shopify platform on your own web store, you can participate in the Shop platform, and that Shop platform is a marketplace facilitator. So when you are utilizing, or if you're utilizing a Shopify scenario, you got to be clear as to which one of those two platforms you're using, because in one situation, you've got to collect the tax and report it, and in the other, Shopify is doing that on your behalf. So just a point there to think about. So if we segue into some options to manage this process on an ongoing basis, there's really, I think, of three things that are necessary to charge the applicable or the correct tax. So we've already, let's say, determined that we've exceeded the nexus standards, whether it's economic or physical. So we do have the obligation to charge the sales tax. What are the elements that I need to be able to apply the applicable tax? And that's the situsing, as Jeff referenced earlier. It's the taxability, is the widget taxable or not? And what is the tax rate in that destination where I'm shipping it? Those are really the three factors that we need to understand. Now, for some businesses, depending on the volume of transactions you have and what you're actually selling, that could be a fairly easy process to manage. But if you're like a lot of e-commerce companies and you're shipping all over the country and you've got nexus in a lot of different states, it's, I would say, impossible to manage that without some type of technology. So you really have to start looking at, well, what's the tax automation or the tax calculation platform that I can leverage? And a lot of the systems, and I referenced Shopify, they have their Shopify tax platform or add-on. It does, I think, an adequate job in most situations of applying tax correctly. I know there's an additional transaction fee associated with utilizing that technology, but I always encourage people to look at, what's the native capability within your shopping cart or within your billing system to manage it within that platform without the need to purchase any type of plug-in solution. Now, a lot of companies will need and will require a plug-in solution. We'll talk about here at the very end how we facilitate that, but there are some very specific companies that have software that integrates to these billing systems. And you've probably heard of companies like Tax, Jeff mentioned earlier, Avalara, there's Vertex, there's Thomson Reuters, there's SureTax, TaxJar's in there. There's practically a new one every day. It seems like they pop up, but those are good technology solutions to automate the application of the sales tax. Now, when you're looking at potentially either leveraging the native capabilities within the shopping cart or within that ERP or invoicing system, and you're also having to look at potentially utilizing a tax engine, you need to understand the categories or the products that those systems cover. And what you're selling, does it match neatly into a product category within that taxing system or that tax engine? And let me try to get a little bit more specific with that. So some of those taxing solutions that are especially the newer ones that are coming out, the tax engines, they're only going to have categories that support SaaS. They've kind of carved off a niche and they say, we want to work with SaaS-based companies, and that's it. So if you're selling anything other than a SaaS solution, that particular platform isn't going to work for you. So you got to make sure you're understanding obviously what you're selling, but also what the capabilities are of the taxing engine. And then the tax mapping that we're referencing here is aligning your product SKUs to those tax categories within the tax engine or within the shopping cart to make sure you get that correct tax treatment. Outside of the tax calculation, there's an ongoing process, and Jeff and I have heard many times over our 25 plus years of managing sales tax, well, once you've charged the sales tax, that's, everything else is easy. Just stick it on a return, you're done. And in theory and in concept, it sounds pretty simple, but there's a little bit more behind it. Specifically when we start looking at the registrations. So again, something that sounds fairly straightforward and simple, but when you go to do that initial registration, there's always going to be some type of question about when did you first have taxable sales in the state. And so now you get stuck in this quagmire of, well, I started selling a year ago and I've had taxable sales for the last year. Do I use that date? If I do that, what happens? So you're in this tricky scenario of, what do I do? And we help advise in those scenarios quite frequently. And in that scenario specifically, if you use that year ago start date, the first thing that's going to happen is you're going to get notices for all of those filing periods for the last 12 months where you didn't file a return. So now you're going to have to file a return. You're going to have to report the tax that you didn't collect. There's going to be fines and penalties. There's all sorts of issues with that. There's also issues with saying, I'm not going to worry about the sins of the past, and I'm going to start doing this correctly from today forward. Not necessarily always the right answer, but there could be circumstances where that makes sense as well. So it's just a tricky scenario to navigate, and we can certainly help you from that perspective. Corporate officer information. Oddly, I've not had a lot of pushback on getting corporate officer information lately. I would have said 2 years ago, almost every time we asked to do a registration and we asked for a social number or an ID, a driver's license of a corporate officer, there was always pushback. Haven't heard that so much lately, but it is a requirement. And specifically what the states are wanting to achieve there is they want to have a person that they can hold accountable for the sales tax obligations of that business. And it's an interesting scenario where a state can go after an individual for sales tax violations, for having not collected sales tax in the past. They can hold that corporate officer responsible, and it's referred to as these responsible party laws. Another somewhat challenging aspect of registering, we often just talk about this from a sales tax perspective, but when you get into some states, there could be multiple different types of quote-unquote sales tax. You could have just a traditional vendor's sales tax, which is generally what we're talking about, where of course the vendor has some type of presence in the state and is required to charge the sales tax based on their presence in the state. There's also a vendor's use tax, which is a scenario where you do not have a presence in the state, but you're required to charge the quote unquote the sales tax, and there's the consumer's use tax as well. And some of the states, each one of those is a different registration, a different return, and potentially a different rate. Not always a big deal, but if you get audited and you've registered for the wrong tax type and you filed the wrong return for the last 3 years, you might have to go back and amend 3 years worth of returns. So just something to be aware of. So outside of that, just having some type of regular process in place to make sure that you're able to get the data from the different data sources, and that might be your own Shopify platform, and it might be from from Amazon, and it might be a invoicing system. So you could have lots of different data coming together onto a single return. So making sure that you've got that mapped out. You've got a filing calendar that isn't static. So when you register with the jurisdiction, they're going to assign a filing frequency. That filing frequency may change over time. You may get quarterly initially, and that may change to monthly. So you have to constantly be on top of that. And then you also have to be aware of any notices. Maybe a state has a question about a return that you have to respond to. And typically these notices, you've got a very limited, short window of time to respond to them. So what we see in the market, in some challenges, and we've titled it here pitfalls, really pitfalls of a lot of the automated, quote unquote, fully automated systems that are out there, kind of fit into two different categories. Very frequently we see scenarios where someone is utilizing Shopify, for example. They're using Shopify Tax. Shopify Tax is calculating the tax due. Maybe you're working with a third-party payment processor to get the payment, but that transaction is now complete. You've charged the sales tax. You've collected the sales tax. You've got a certain amount of sales tax to report. We have automated competitors that will now take your quote-unquote data from Shopify. They will recalculate everything based on their taxability rules, based on their tax rates, and then they'll remit the return based on what they calculated and what they determine is due, not what was actually collected and what is truly due. So it creates an issue for businesses from a reconciliation standpoint, where you might be reporting a different number than what you actually charged and collected. So it's a problem that you got to be aware of. We also see issues with these fully automated solutions where there's really no human intervention at all. And the issue there is, and I'll just point out one scenario, you've got a notice that gets posted in the online e-file site. Well, who's looking at that notice? The quote-unquote automated auto file scenario, nobody's looking for those notices. And now you've missed that scenario where you've gone from a quarterly to a monthly filing frequency. Nobody's caught that. Nobody's changed the filing frequency. And now you're delinquent for 2 months of returns before you realize that you should be filing monthly. So there's pitfalls to these automated solutions. So with that as the segue, from a TaxConnex perspective, we've launched the TaxC product, which is really a combination of the automated sales tax calculation solution, but it's paired with human oversight and human intervention to really, it's probably an overused terminology, but it's really kind of the best of both worlds. So you do have a professional tax person that's watching over the process, but you're leveraging the technology where it's critical and where it's necessary. But then you also have access to that sales tax professional when or if you need any additional assistance. Explain the Chicago lease tax. Under what circumstances a vendor have to file this?
Well, there's two primary types of leases that come to mind as I try to watch that softball come over the plate. One is just tangible personal property, so standard operating leases. Interestingly, the state of Illinois, and this is very rare, all the other states treat leases essentially the same as a sales. But in Illinois, generally or historically at least, sales tax was not imposed on the rental receipts of tangible personal property. Now, Illinois has come out with some real recent legislation. They're changing that rule. It's going to have some different impacts on things. But I'm speaking historically that Illinois generally didn't tax leases. So Chicago thought to themselves, well, we have an opportunity here. So they enacted a lease tax that encompassed leases of tangible personal property. But the one that probably strikes people as most surprising and odd is the lease tax that's imposed on software as a service. And there's some specific language in the way Chicago defines SaaS products for purposes of this task, but it is standard SaaS that we find ourselves liable for within the city of Chicago. So if you're licensing or providing the subscription to SaaS to customers in Chicago, those seats that are based in Chicago are going to be deemed to have received the benefit of use of that software in Chicago. And the tax on that, I believe, is currently 11%. It went up dramatically.
It changed from 9, what?
It was 9%, and it changed dramatically. I believe it's 11 as of the beginning of this year. So it's a very significant tax implication. They're very aggressive about it. They like to trap you in Nexus, and they're going to define something as SaaS if it's close to being defined as SaaS.
So Jeff, in 3 minutes or less, what are some of the challenges with doing a VDA?
The challenges of doing a VDA?
Yeah, that's the question.
Yeah, I would say that, we do a ton of VDAs. And as Brian can attest, I'm the guy that talks people out of doing VDAs very commonly. I love them, and they have a place, and they have a purpose, and they're really fantastic. But I don't believe they're for everybody, and I don't believe all businesses should just jump at it because of the somewhat obvious benefits associated with it. When you ask what are the challenges, I would say that there's not a lot of challenges. Every VDA is a little bit different. Every state has a little bit of a different rule and requirement associated with it. Certainly, you have to have the ability to calculate your tax liability for a 36 to 48 month period, depending on the state. Some states are a little further back than that. Another thing about VDAs is when I was talking about going back in time 36 to 48 months, that's what we refer to as the limited look-back period. The limited look-back period does not apply to taxes that are collected. So as far back as you've collected a dollar, that's how far back you've got to go to capture that dollar and include it in your voluntary disclosure program. There's a couple of nuanced states that I'll speak to. New York, sometimes New York gets a little bit behind or a lot behind on their VDA processing. So you might engage in an application that you might not hear from them for 4 to 6 months. Virginia has a similar challenge, and it's resource constraints. You might not hear back from them and then even after you hear back from them and you ultimately disclose your liability, it may take almost a year before you get your final assessment. And what's tricky about all of that is, in the meantime, you need to be alert to that. And in New York and even in Virginia, what you want to do is be prepared to initiate your registration and start complying shortly after you've initiated the application. And that's true in most of the states, by the way, that you want to do that. But most of the other states, there's more of a real-time application processing and a real-time execution of the overall VDA.
Yeah, and we're happy to have a one-on-one conversation about that because it's very fact-driven, very specific for each individual company as to why and when and what the benefits are. So feel free to reach back out to us on that if you want more detail. But we're going to go ahead and wrap up. So we definitely appreciate everybody joining us and look forward to hopefully chatting with some of you in the future. And hopefully you enjoyed this and you want to come back. Thank you, everyone. Have a nice day. This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.